Hello, good morning, and this is Tony from FinancialJuice and MACROACE. Hopefully you're doing all well and enjoying your Friday morning. So we've got quite an important day, well, last data point, major data point before we get the Fed interest rate decision next week. We've got consumer spending and the PCE price index data. So it might not influence the Fed's decision next week. But it could do, depending on how inflation plays out today. But we've got a bit of sentiment to go through and what the expectations for the release, how it reacted last time. But yes, good morning, Andy. Good morning to you too. So US consumer spending, let's get through it then. So first of all, what is consumer spending? So it shows how much consumers are spending on goods and services. And the other important key difference when we're looking at the PCE price index and the CPI price index data. So the PCE price index is a general measure of inflation across the US. Okay, that's including rural areas as well. Then you have the CPI price index, or the CPI data that measures inflation in urban areas, so your towns and cities, where there's a lot more spending that goes on. So the PC price index is the preferred measure of the Federal Reserve because they get a clearer or better outlook as to what inflation is like overall. But of course, the CPI price index does have a huge influence, as it has done in the past with the Fed's rate decisions, depending on how inflation plays out. But now people are expecting seeing that decline happening in traders as well as is the Fed, and there is the expectation for the Federal Reserve to go with a 25 basis point hike next week rather than doing a 50. And then the question would be, does the Federal Reserve go with a pause at the meeting after that, or do they stick with the 25? So do they go with the Bank of Canada's style of doing a 25 basis point hike and then pausing? Or do they carry on raising interest rates into the year? So the other thing, as said, to be aware of is how does it affect the markets? Very simple. Currency, if you do see a healthy increase or pickup in consumer spending and income, that usually bodes well for the US dollar. High consumer spending and demand encourages more growth, right? And that puts upward pressure on interest rates, as PC inflation has done with the expectation with the Fed in the past of them raising by an aggressive amount, coupled with the CPI data and the jobs data that we've seen in the US as well. But the other thing is to understand is that the currency, as said, will appreciate in the anticipation of higher rates, or that the US economy is doing well, the consumers are doing well. So there's confidence that comes into the markets there in the short term. Then for the stock market, you have higher personal income and spending that are viewed favorably to the stock market. In the normal circumstances, that will fuel more economic activity and increase profits. But in this current tightening cycle, it's a different story. There's the current point of view that if inflation is stronger than expected, then that could lead to the Federal Reserve maybe doing an extra hike, or maybe hiking for longer, depending on what PCE consumer spending, how strong consumer spending is. Of course, that will drive inflation in the US, and whether or not, whether they feel that that's going to be strong enough for them to kind of sway their decision for any upcoming meetings. So for the stock market, you would expect, what we've seen in the past, is more of a depreciation from the stock indexes in the short term, in anticipation the Fed could raise rates or could stick with their tightening policy or tightening of monetary policy for longer than previously anticipated. For the bond market, if you're trading bonds, there are two ways you can look at it and understand it. So bond yields, whenever you see bond yields, whenever bond yields react to positive data within the US, particularly in this tightening cycle that we're about to be coming out of, maybe pretty soon, then bond yields will try to price in, will start going higher in anticipation of a higher rate of interest. On the flip side, without the tightening cycle occurring, bond yields will still go up because that means that the economy is doing well, and you have people who are more attracted to the stock market. So the government, what they do is they will increase the yield in the bond market to try and attract those traders or those investors to invest in bonds. So bond yields will go up. So inverse, or the inverse relationship is that, of course, if bond yields are higher, the bond price is lower. Okay, so they make it nice, cheap, and attractive, or cheaper and more attractive to invest in. But that, as said, it could also mean that traders are expecting a high rate of interest as well. So that's how it affects the markets. Don't forget to share the video, like the video, to subscribe to the channel as well. Get the video out there, get the name out there if you find this information useful so far. But let's go into the previous report as well. So you had within services, the largest contributor to the increase was spending on housing. Within goods, spending on new motor vehicles, mainly new light trucks, was the leading contributor to the decrease. So consumer spending, although it is still, you're seeing a decline in some of the durable goods areas. Of course, the data that we had for GDP yesterday smashed the data, or the forecast, and also the previous figure that we had yesterday for durable goods orders. But it doesn't mean that the consumer spending has picked up in tow with it. It doesn't mean it always picks up in tow with it all the time. There may be a bit of a lag. So that's what the November report could be suggesting, that there was a bit of a lag although yes, there were more new orders being made for durable goods, but consumer spending in those areas for durable goods, for vehicles, had declined a little bit. It was the largest contributor, to the decrease. But housing is also the other thing to be aware of. If people are spending more of their housing for their rent or their energy. Remember, the PC price index doesn't put too much of a weight on the energy side because that's more volatile, and it can distort the image a bit more when you're looking at the headline figure, the PC price index, the year-on-year data, or the month-on-month. But that's one thing to be aware of on the last report. So if we're looking at inflation overall and the spending or consumer spending overall in the US, going back to May of 2022. And then here we can see that, of course, personal incomes, you can see that there has been in regards to spending, as personal incomes have dropped off or declined, so has spending. So one point to be aware of, or something to be aware of, or I guess be cautious of, is, does that go into the negative territory with personal income or spending? Now, if wage prices are still quite fairly strong in the US compared to what they were historically, and particularly if we're looking at during the pandemic era, then we've just got to be aware that with interest rate hikes, or with these interest rates hikes occurring, that is going to have an obvious effect on people getting, first of all, spending, first of all, businesses, how much income that they pay their workers. Does that decrease a little bit? And then, of course, that feeds into consumer spending for the consumer's outlays. Do they spend that much, or do they start to spend less during that period? Then the key point, or the key thing, well, of course, is going to be December. Of course, you have your holiday shopping, so you could see there is a potential for it could be a bit of a surprise for an upside move if you do see a bit of a pickup in the inflation figures. Maybe not against the forecast, but there could be a little surprise in store, maybe. But that's we've got to wait and see for the data. And then if we're looking at the PC price index data, so you've seen this nice gradual decline in inflation over time. Although, yeah, it has been a bit rocky and it's been a little bit bumpy Okay, particularly with the core side, it's still more or less what the Federal Reserve wants to see. Is this a nice clean decline rather than any erratic moves up or down in either the core data or the headline data itself. So if if you do see continuation, if we're not looking at the forecast figure, if you're just comparing it to the prior, if you do get a smaller figure than the prior figure overall for the PCE data, then that would bode well for first of all the Federal Reserve, in their point of view, showing that their work is more or less done, or nearly done, or is working, and they can pause much sooner rather than later. But on the flip side, if you do have the conflicting data with CPI, if you do have a mixed report with CPI, the next time around that we get the CPI data, that could muddy the water. But we've already had it, and it's at 6.5%. So it's not surprising that the Federal Reserve decides to pause at the meeting afterwards, because in the past, central banks have had a tendency to pause with their tightening cycle much sooner than people would anticipate or traders would anticipate. What I mean by that is that if the rate of inflation is at least 3 times the amount of what their objective is, then if it is seen to have a steady decline, or a nice decline over time, then it's not surprised that the Fed could pause sooner rather than later. That's if the PC price index data plays well and the CPI data for the upcoming, not for the upcoming meeting, or for the meeting after the one we have next week. So the views then for the US consumer spending. So we have a bit of commentary from the Bank of England's PIL, which I thought would be quite interesting to take note of. PIL saying there have been some, albeit tentative, signs of normalization in US consumer demand patterns, i.e. you're not seeing huge, crazy big swings in consumer spending where they're just rushing out every day to just buy and consume. But then you have Bank of America CEO Moynihan said the consumer is extremely resilient, something that he said previously in the past as well. There's nothing completely new, but still it's important to note within getting towards the end of the Federal Reserve's tightening cycle with the high rate of interest that they have, that it's still important to understand that consumers won't be hit that much, maybe, from the high rates of interest. But it does take up to a year, or about a year or so, for interest rates to take effect in the economy. So we'll see how that kind of changes later on. Goldman Sachs CFO said the bank is seeing early signs of consumer credit deterioration. So slightly different story to Moynihan, not saying that it's going bad, but it is becoming a bit weaker, which again is also something that is more or less expected. Then you have the UMich survey on January 13th. The year-ahead inflation expectations receded for the 4th straight month, the lowest since April 2021. So if inflation expectations are going down, then also consumers, that of course, if consumers are feeling more comfortable with or expecting lower prices over time for the year ahead. All right, so where is the economy at the moment then? So I said inflation's at 6.5% compared to the prior 7.1%. Nice big old drop in inflation there. Non-farm payrolls was at 223k versus 263k. Retail sales in the US was at minus 1.1% versus the prior of minus 0.6%. Core retail sales, again, same as the retail sales versus the prior of minus 0.2%. Consumer credit was at 28 billion versus 27 billion. And then you had the unemployment rate, which was lower than previous, or 0.2% at 3.5% versus 3.7%. And then yesterday we had a Q4 GDP data, or the advanced data for the US. It was better than expected. Forecast was 2.6% and we got 2.9%. So the dollar enjoyed the initial pump off the back of that data. The S&P didn't, but it was more or less a quick reaction within markets. It pulled back quite quickly. It didn't take for too long for the markets to kind of jump in and then jump out. But if we're looking at comparing it to a third quarter, so it was at 2.9% versus the third quarter data of 3.2%. Then the University of Michigan inflation data, which we're getting the final read for today for the University of Michigan, was at 4% versus the prior of 4.4%, and then the 5-year ahead inflation expectation of 3% versus 2.9%. So this is just kind of the reason why we're looking at these bits of data here is, one, to show where is inflation, what is inflation like in the urban areas, okay? Second of all, how productive how productive can the US be with the amount of jobs that are being added to the US economy, okay? And then what is spending like overall anyway? So if you can see retail sales, which makes up a big chunk of consumer spending, if retail sales is seeing a decline, or a decent decline, then you'd expect some sort of a decline in consumer spending as well. Consumer credit, though, was up slightly, but not by about $1 billion. So again, are consumers taking out more money to spend on goods and services, or they're using it for their own housing and the other necessities that they need rather than want of goods and services that they need. So that's also another factor that plays in too. And then productivity, again, if the US is more productive than what markets were anticipating yesterday, that paints a brighter picture for the economy. If all these rate hikes that have occurred, and super quick rate hikes, which, as I said, still yet to take actual effect in the economy, if they're to still be very productive, then it could mean that you could see there may be the chance of no recession at all. I'm not going to claim that that's my point of view, right? I'm not going to, I'm not predicting a recession. It's not, that's not my point of view, But one thing we've got to be aware of is that there is still a possibility of a minor recession occurring. All right, so the triggers then for the... Yeah, I thought you guys would like that. So the triggers then for the economic release. Consumer spending of the high estimate of 0.3% and low estimate of minus 0.5%. Personal income with a high estimate of 0.5% and a low of 0%. PC price index month on month with a high estimate of 0.3% with a low estimate of minus 0.1%. The PC year on year with a high expectation, according to economists, what they see, with a high estimate of 5.1% with a low of 4.2%. Core PC price index month on month with a high estimate of 0.4%. Sorry, I was just so the reason why I did the echo sound, if you're wondering why I paused, there is a video on YouTube called The Price Master. It's very hold on, I'm just gonna share with you guys. I know I've got about 10 minutes left, so screw it. I'll just share with you guys. I'll share with you the hold on. Where is this? Here we are. the Price Master. So this, no, we're not finished yet. That is a video of the Price Master, a dude who, it's a garage sale that happens. People ask him like for a price, and he just goes crazy, and he just gives his own like offer. So like, for example, he would go like $5 billion is what. As one example of what he would do. Anyways, getting back to the important stuff. the yes, that is how the Fed does conduct their bond auctions. It's basically, you have the Fed, we have Fed's power that's sat there, right? And I don't know, somebody from BlackRock or like JP Morgan says, hey, Powell, can we have how much can we borrow for our loans? And then you have Fed's power that goes $10 billion. So that's probably how it goes. Anyway, so the core PC price index year on year, the high estimate of 4.8% and a low of 4.3%. So overall, we're looking at if I go further in and we look at what the Fed is, what their views are as well. Fed's Bostic says holiday shopping numbers could also influence the decision if consumers prove more or less resilient. Ukamak says just 10. Sludge says I'm awake now. Fed's Daily says that on January 9th, that PC inflation, so she sees it in the low 3% range later this year, and sees PC inflation closer to 2% by the end of 2024 and 2% early 2025. Barkin says despite earlier recession scares, data on spending and investment and employment have pushed the risk out. Fed's Bullard says that households in the US are still flush and this should boost consumer spending this year. If we look at the previous release as well, how they reacted in the market, so going back on December 23rd, it was about 10 seconds before the previous release that we had. So you can see the markets were trying to react before the release had even come out to the market. So they were expecting, first of all, data to be weaker for the consumer price index data. So we kind of took a little bit of time for the PC price index data to come through. Consumer spending was slightly worse than expected. But again, markets were still kind of waiting for the PC data. Kind of skip ahead. Whoops. Whoops. Hold on. Sorry about that. I think it just came out. Well, the previous one. I'm trying to get it on the dot for you. See what we got. So, yeah. Okay, so, I'm trying to get the time for you. There you go. So the data was more or less in line with expectation. But the markets had already reacted beforehand. Maybe expecting, they might have been expecting a surprise. But now you can see that once the data come out, the S&P 500 was actually trying to claw itself back up, even before the data come out for the PC data. The dollar had more of a mixed reaction as well. But the key thing is, if the data is in line with expectation, that's going to cause some confusion for the markets. Okay, because one way you could take it is that that inflation, yes, the PC inflation is going down, but it wasn't weaker. It wasn't weaker than expected enough for the stock market to see a movement towards the upside. The other reason being, you can see here the S&P was moving down and the dollar started moving back up. The other reason being, or the other thought behind what the initial reactions to, is that if the data is in line with expectation, that that inflation is coming down and it's not heating, or it's not overheating or higher than expected. So there's also that sentiment, and that's something to be aware of too. So with the market reaction, if you do get data that's in line with expectation, we don't get a clear way forward where data points in one way going up or down for the PC inflation data, then that could cause confusion in the markets, as it had done there for the inflation, as it had done there for the S&P. But of course, the consumer spending data is important too, because if that is weaker than expected, that could also mean that the focus is, will consumers be able to handle the higher rate of interest, or maybe they're they might not be able to handle high rate of interest. And that could cause some loss of confidence within the stock market. But of course, good news is bad news, and bad news is good news from what we've seen with the inflation data, okay, and also with the jobs report too. So that's something that's again something to be aware of. If we go to the deviations, then if I just pull that out of the way, get rid of that. That's all we've looked at. Let's go. Let's put it up here. So spending. There we go. All right. So I have a lot of data here. If we kind of scroll down, here we are. So December 23rd, right? What we had. So consumer spending, see, it was mixed. You didn't get a clear direction or one way that the data had gone, but you still had a decent reaction, more from the stock indexes compared to the currency pairs. Okay, so you can see here on the Nasdaq, you had 277 ticks towards the upside. The S&P had seen about 80 ticks towards the upside, and then the Dow has seen 88. But then after about 10 minutes of trading, it was down. It was still up around 196 after. Oops, I shouldn't say. But yes, so that's how the markets reacted to his mixed data that we had seen from the markets. So that's one thing to be aware of. So the currency market maybe not see too much reaction to the data, but as we can see, it's the stock indexes that see more of a reaction. Gold didn't see too much of a reaction either, as did the bond market as well. So that's something which you've got to be aware of, or just to be kind of careful or cautious of, that if you do get data that's in line with expectation, could see more of confusion that occurs within the market. So we've got about less than 2 minutes left. We've got a minute and a half left with the data. All right. So don't forget Financial Juice live, the live voice and text data. I'm just going to get my TICKSTRIKE up and running as well for see how strongly the markets react. Okay, 1 minute. 1 minute remaining. So consumer spending month to month is going to be your first release to look out for. First, we'll see how strong consumer spending is within the US. And then, of course, focus will shift. Well, either we get the PC inflation data first, and that could rock the markets, or we get. So you're more or less, as I said, looking to get a decent reaction or nice big reaction. You want to see data going in one direction overall for the PC inflation data, rather than being in line with expectation, which will make it harder to react to the market. 10 seconds. We might not get a clean reaction compared to what we've seen in the past. Okay, so markets are trying to move beforehand. Okay, minus 0.2%, minus 0.2%, lower than forecast of minus 0.1% for consumer spending month to month. Personal income, and as expected, at 0.2%. Dollar yen. Okay, PC price index 5% as expected. We're looking at the core PCE price index month on month, spot 3% as expected. PC price index month on month, spot 1%, higher than the forecast of 0%. Core PC price index 4% as expected. Personal income, real personal consumption month on month, minus 0.3%, lower than the forecast of minus 0.1%. So not seeing too much a reaction there from the market. We did see the market try and pop off before the data had come out, but again, the data was more or less in line with expectation. The consumer spending was worse than expected, but you didn't see, again, there wasn't that much of a reaction from the currency pairs. Let's have a look. We'll have a check anyway. See what we got. So let's go with dollar yen, and then I'll jump to the S&P. Yeah, that was that's about 11.5 pips down on the dollar yen. Let's kind of look at this. Okay. So we're doing it on the minute. There it is. So yeah, not that much on the S&P. Let's go on the NQ, which gives us a nice juicy figure. Let's see what we got. Okay, 172, but 160 or 170 ticks, 168 ticks down on the NQ. So the Dow as well. So we're seeing a bigger reaction, or more of a reaction from the stock indexes off of the initial reaction from what we've seen from the data. But now, as I said, because the data is, there's nothing outstanding. There was no big surprises from the data. So the Dow, about 35 ticks down. There were no big surprises from that data. So the markets are the way that they are with this data here. So nobody's really shocked or enthused by it, let's say. But look at the bond price on 2-year bonds. Okay, that's 5 ticks towards the upside. So more or less, oh yes, let's check gold too. Gold had a bit of fun last time. Okay, dollar is still going down though. Right, so the dollar's down, gold should be up. It's a bit strange, is it? It doesn't really move. That's 13 ticks. It's nothing. Not much of a reaction, but now you're seeing, gold move towards the upside as the dollar is continuing to weaken. Let's look at GBUSD. Let's go cable. That's always a nice currency pair. Nah. Right, that's yeah, that was dead. that's hardly anything. So yeah, you're not going to get much of a reaction from the currency pairs, or noticeable reaction from the initial move that we had seen from the currency pairs. So that was the release. If we're looking, okay, here's an important bit. So Fed Fund futures prices continue to reflect expectation for a 25 basis point rate hike next week, plus one more 25 basis point hike before stopping. So not going exactly the way, following the exact path of what the Bank of Canada is doing, of doing 125 basis point hike and then pausing in the next meeting. But doesn't mean that the Federal Reserve can't do that or won't do that, but markets are expecting them to do another rate hike. And the only reason would be is that, yeah, inflation is the PC inflation is going down, but maybe they might need to do just one more 25, and that'll be it. It's not a complete conclusion or to the fight against inflation. That's what I can summarize from what the Fed Fund futures are trying to price in there, from how they've reacted to the market. But you can see here, trading wise, I mean, good luck to you. choppy whipsaw reactions here. It doesn't make it a nice clean break. So we didn't get data going in one direction for the PC data. It was just more in line with expectation and more slightly higher. It was a meh. It's just boring. Okay. Now to the other exciting bit then. So, right. FinancialJuice, what I've been using here for looking at the data. So if you have never come across a live voice and text service giving you market updates, then FinancialJuice is the place to go. So if you think about it, the big boys, the investment banks, right, they have access to a live voice and text service because they can capitalize on it, and they know that they know about it. They capitalize on potential trades or manage their risk, something that's not readily available to the retail trader. Okay, that they probably don't have, might not have too much access to. So having a live voice and text service is advantageous because of what I said, of what investment banks do. Is they use it to capitalize on potential trades or manage the risk if there's a certain headline that's come through. Maybe it's about the Bank of Japan with not expanding their yield curve band width, or maybe continuing with the monetary easing with the markets, or expect them to maybe become a little bit more hawkish, and that affected the yen, where the yen just became crippled from that bit of news. If you're a yen trader, maybe you might have seen the move happen, yes, but you might be thinking, why did that move happen? So that's what FinancialJuice is here for, is giving you an explanation or giving you the headlines and trying to explain to you why a move might be happening within the markets as best as we can. So there, if you would like to, right, and it's totally down to you guys and what you want to do, there is a 7-day free trial of the pro version of FinancialJuice. But the only thing if you don't want to pay for the service, that's completely fine. You can use the live version of FinancialJuice. What's the difference? The live version has adverts that are played, advert banners, okay, headlines. There is a delay to the website as well. So yes, it's still useful to use, but to really take hold of the usefulness of a live voice and text service like investment banks do, you want to be able to capitalize on those potential opportunities, particularly if you're a day trader, right? You want to know what's going on in the now, so you can capitalize on whatever opportunity that is presented to you, rather than having to, kind of figure out what's going on by just looking at the markets. Or maybe there's a bit of news that's way older, and it's gone. So, but yeah, if you do want to sign up to the pro version of FinancialJuice, what you need to do first is make an account on FinancialJuice, get your username and your login. Then go to your email, verify your account, and then once you've verified it, there'll be a little button here that says Go Pro. You can click on that, and then you can choose what you want to, what kind of subscription that you want. Once you've paid for it, then you go back to the website, log, either so just log out and log back in again to the website, and then you'll have this beautiful thing here. Okay. Now, so that's FinancialJuice. I'll put that here for you. That's the link there to sign up there. Yes, Saga, I still record all the moves. That's me. That's completely free, so that you guys have access to. If you sign up to MACROACE mailing list, okay. So the MACROACE mailing list, what it does, it shows you, of course, as said, the deviations for the upcoming economic releases for the week. And it gives you a bit of a summary of what to expect for the week ahead for the US, Asia session, European session, and then a summary of the weekend news as well. So it's not a big, massive email. It's not filled with graphs and charts. It's simple. The data or the juicy bit comes through when I talk to you about it in these live streams here of what to expect, what could happen within the markets. So how do you get access to that? Right, that's your next question, as I got. So, that is the link to the MACROACE mailing list. Again, it's completely free. What I'm doing here, right? No charge to it at all. If you find the information useful, then what I ask you to do is just get the word out there. Pump the name out there. If you find the information useful and handy as well. So then other final couple of bits too. So TICKSTRIKE, we've been looking at here. So you might have seen. Ooh, wow, that's why it wasn't going off. So TICKSTRIKE, what is TICKSTRIKE? A simple way, it lets you listen to how strong the buying or selling momentum is within a certain asset class or assets that you may be looking at. So if I give you an example here, so if we're looking at cable here as one example. So this is what we call a ticker. What is the minus and plus figures all about? So minus figure shows you there's selling momentum, and then the plus figure shows you there's buying momentum. Now you have a slider here that changes the level of the sensitivity. Level 1 is the most sensitive to market reactions. So if there's a bit of buying or selling that goes on, then there you go. You can kind of see it there. TICKSTRIKE will go off, and you can see the ticker for cable going up as well. But if you want to see when but what you can do is you can push that slider up, right, to whatever you want it to be. The max is 15. Level 15 is the least reactive to market reactions, or least sensitive to market reactions. So only when there's a big amount of buying or selling momentum that occurs will TICKSTRIKE show you a signal visually and audibly. I've turned the audio off for now because otherwise you'll keep going, and I don't want you guys to get distracted. I want you to listen to me and my voice. But yes, so that's cable there. So again, so if you're a day trader, right, you're like scalping the markets, right, then TICKSTRIKE is the perfect addition to your tools to use within the markets as well. Of course, the key thing is use it however you want to use it, whatever works for you. If you've never used TICKSTRIKE before, if you have found it useful, then spread the word about it, get it out there, and make people aware of it even more. But TICKSTRIKE, as said, so there is a 7-day free trial of TICKSTRIKE that you can have a little look at, right? Have a little play with, see what you like, see what works for you. And then finally, we have unusual activity. So unusual activity, so if you like trading unusual volume activity in stocks, Forex, crypto, futures, okay, then you can join our free beta test group of our new service. Okay, that's the link there of unusual activity that we have there. So any sort of like stock or asset that doesn't really that sees an unusual amount of movement, okay, compared to how it normally moves during trading hours, then unusual activity will give you an alert depending on what you're looking at, and that's again another tool to kind of use and play around with. That's currently, as I said, that's free. Have a little play with it. Give us your feedback on what you think about unusual activity. But next week is going to be busy, guys. So we have Fed, Bank of England, ECB, non-farm payrolls. Oh, hell yeah. It's going to be a busy, busy week. But thank you very much for joining me live for consumer spending. It was a little bit of a flop with the data, but thank you very much. Have a great weekend. Don't forget to like the video, share it, subscribe to the channel as well. Get the video out there. Share it with your family, your wife, your brother, your sister, your mum and your dad, or your pet dog, your goldfish. Just get the word out there. All right, I'll see you guys next time. All right, bye. Oh, just let you know that email is sent out on a Sunday. So it's sent out once a week.